Good morning, good morning. I'm Mark Phillips here at Harvested Financial, and we are looking at the markets on today, Tuesday, February 19th. So let's take a look at the snapshot. We have the SPY trading at 389.87. That's down 66 cents or 18 basis points. We have the VIX cash up 63 cents. We have IWM just up a hair, 17 cents or 6 basis points. We have the Qs off just a bit, off 37 cents or 11 basis points. So what are we going to talk about today? Well, today is Tuesday, and it is time to talk about collar strategies. So collar strategies make an amazing way to handle gains in stocks, and we're going to look at Microsoft today. Microsoft is already up 11% on the year, and what can we think about doing here to lock in some gains? So I'm going to pull up my Trade Hawk as always and take a look at some simple collar strategies that we can start playing with in Microsoft. So Microsoft, famously known for giving lots of employee-based compensation. They're allowed to buy equity at a 20% discount. So there are lots of employees that are concentrated holders of Microsoft stock. And now that's been great. We're a little over a month into the year, and with stock up just over 11%, that's a great way to have an additional form of compensation that aligns you very well with the company. However, we need to start thinking about diversification. And diversification is one of those super important investing maxims that having too many eggs in one basket puts a lot of risk. Not only is your job in one place, your money's all in one place too. So what kind of collar opportunities can we do here? So remember, collar, buy a put and sell a call. We also have a really fun variant of that where you buy a put and you sell a call spread, so you get a slingshot, whereas if that stock really pops, you get some room to run. So we're going to take a look at both of those today here. I want to go out a little bit farther. So typically with collar strategies, we like to go out a little bit further because that doesn't require as frequent rolling and management of the position. One decision point there, though, is if you are going to do more short-dated collars, that does give you some opportunity to reset. A collar is a form of locking in the value of your position. So when you lock in that value, you are going to lock that in for 1 month, 6 months, 12 months, whatever the duration of your trade. To the extent that you want to lock that value in more frequently and manage your exposure on a more granular basis, you can do that. It just does require more frequent trading. Now, Harvested Financial, systematic option strategy execution, that's what we do. No matter what the interval is, we can continue to roll a collar however it fits your risk profile. So, like I mentioned though, I think I'm going to go out a little bit far in the term structure here and show what some of the opportunities look like. So I'm going to be looking at the July option. So the July 16th expiration is about it's exactly 156 days away. So with stock trading at 242, what are some basic collar levels that we can get? Well, if we want really tight protection, we don't want stock to go down at all. We want to lock in our 240 level. Well, our 240 put is going to cost us $17. So we need to find a call that can offset the price of that put. Paying $17, actually to be precise, it's $17.50, 45 cents. We're going to need to buy the 240 and sell the 245. So stock's almost exactly split right in the middle. Actually, it's trading up to 243 right now. But this is the closest we can find to a 0%, zero cost collar. By 0%, I mean there's almost no upside range and there's very little downside range either. These are the two tightest strikes in this July expiration. There's nothing in between. Perhaps if we did have more granular strike listings like we often see in the weeklies, we would be able to get something tighter. But right now at this $5 interval, we have to buy the 240 for $17.40 and sell the 245 at about $17.30. How you actually get executed here is going to make all the difference. But looking like this will trade for around a 20-cent debit. So paying 20 cents a share of Microsoft here would lock in your value below 240 and above 245. So very tight range under which that can perform. If you're willing to give yourself a little bit more room, say perhaps a 5% buffer here. So a 5%, let's go down, not exactly, but the 230 level. So the 230 level trading around 13 bucks. That would give us up to the 255 level in exposure. So about $23, 22 and change of upside exposure, and a little less than 22 in downside exposure. This is trading also around even. So as you can see here, you can pick whatever percent range you're interested in for your option strategy, for your collar strategy more specifically. Interestingly, when we come closer, so I'm going to go all the way forward to the March expiration, they're not that much different. While the nominal prices of the options will change, the percent range that you will get in this collar won't change all that much. So if I go to the 245 240 put in March. I'm going to pay around 680 for that. And I'm going to sell the 245 at almost exactly the same level. This might be trading a few pennies higher. Some of this has to do with the markets, but the idea is that that 240, 245 collar in March is going to be the exact same price. So effectively, this locks in your price to March for the same cost as it would lock in your cost to July for the same price. It all comes down to how frequently you want to adjust this basis. So same thing is going to happen with further out of the money. If we go to that 230 level, around 350, to collect that 350, well, we're not going to quite get it at the 255 level. That near-term protection is bid up a little bit more, it seems like, in terms of the skew on the downside. So we're going to pay a little bit more to get that same 230, 255 coverage that we saw in the further out month. Part of that has to do with the expected forward value of the stock. Some of that has to do with the dynamics of the skew. Some interesting things at play here that affect the exact pricing. But really what it comes down to is investors deciding where they feel comfortable and how much they want to give up. So really quickly, I mentioned that a variant of this might be considering a slingshot. So if you're really bullish on Microsoft, this particularly works well in the longer term. We can do something like buying the 225. Actually, let's go back to that 230. That's a nice strike. 230, so you get 13 bucks of downside. So you pay $13 for that. Oh, that's convenient. But then now I need to collect $13 to offset that. And so, how can I do that? Well, simply selling the 255 like we did. Boom, that's an easy way to do that. But I can also sell a spread. So one way to think about that would be to sell spreads over time. So if I look at the March 37 and I think about how many different expiration days, I'm going to get about 4 expiration cycles. So if I want to have 4 expiration cycles for me to generate 13 bucks in cash, well, I have my 230 protect out in the far date. So 13 divided by 4, that's going to be a little over $3.25. So I need to collect $3.25 in March on a call spread. Well, if I sell the 250 265 call spread, that actually comes out to 330 right there. So, well, I'll remove this put to get a more clear idea. So yeah, 330. So if I sell the 250 265 call spread, now I'm only giving up the first $15 or $18 of upside here, up to 265. It's actually $20 of upside. But I do get a little bit before that. So I do get the first $7, but then I give up the next 15 and collect that $3. So if I want to roll this forward over time, I give myself a little bit of room for Microsoft to go up. But then if it really goes up, if I really see that slingshot up above 65, I start participating again. So we can use these slingshots over time by selling call spreads throughout the duration of that trade to potentially finance that July put that you have. So some really fun things you can do with Microsoft, especially with a stock that's trading up 11% on the year. It's a great time to think about locking in your gains and how you want to manage this allocation of capital going forward. Harvested Financial excels at systematic strategies and implementing these over time. They can be very tedious to roll that option to manage your front month spread versus your back month put. So come to a professional. Harvested Financial, collar strategies, covered calls, all kinds of fun overlay strategies on stocks. You can check us out here. Every Tuesday we're talking about collars. Every Wednesday we're talking about a different strategy. Every Thursday we're talking about a different strategy. So tune in, subscribe to us. Also check out our Twitter at harvested_DAFE because derivatives are for everyone. Thanks so much for tuning in, everyone.